Hi everyone, thanks for joining us today for the State of Real Estate webinar. We're going to give everyone just another minute or two to join and then we'll get started. Thanks. Okay everyone, thanks for waiting. My name is Riley from CB Insights and I'll be walking you through a few housekeeping items before turning it over to Alex for the presentation. First, don't worry about taking notes as we'll be sending both the slides and the recording to you right after the webinar. Second, if you have any technical difficulties during the webinar, your best bet is to reach out to the Citrix Help Desk. You can also tweet at us or send an email to webinar@cbinsights.com and we'll do our best to help. But again, we'll send everything out afterwards, so don't worry too much. Okay, so as with all of our webinars, we'll be moving through a lot of data and insights and doing it pretty quickly. But we also want to make sure we're answering your questions and keeping this relevant. So throughout the webinar, feel free to ask us questions using the questions tab within GoToWebinar or via Twitter, and we're at CB Insights. So a little bit about CB Insights. We're a private market database where we track all the private companies in the world, including all the financing and investment activity related to them, to help our clients answer questions about major trends, competitor strategy, potential disruptors, and much more. Here you can see a few of our happy customers. Okay, so a little bit about Alex. Alex is a tech industry analyst here at CB Insights. His research has been cited in the New York Times, and he's a graduate from Vanderbilt University. Before CB Insights, Alex held roles at Simpson, Thacher & Bartlett and the Blackstone Group. I'm going to hand it off to him for the presentation.
Okay, thank you, Riley, for that introduction, and thank you all for joining us. We just want to let you know that we have a lot here to cover today, but that the full recording and PDF will be distributed after the presentation. I'm just going to quickly walk you through the table of contents we prepared. We're first going to take a look at the real estate industry and the real estate tech industry from a high level to get you familiar with general terms and concepts. Then we're going to dive into global US and smart money financing trends, followed by financing trends in the United Kingdom, India, and China. And lastly, we'll wrap up by looking at some trends we're watching with some early stage companies we think are doing some quite interesting things. So we'll jump right in. So first we'll take a look at the real estate tech industry from a high level, but we want to define real estate tech for you first. And we define real estate technology as software, tools, and platforms that are used by participants in the real estate industry. And this includes brokers, investors, mortgage lenders, property owners, and managers. First, we thought for context it'd be interesting to look at what real estate means as an asset class. So as of 2015, the global value of real estate equaled $217 trillion. And just for some context, the total value of all gold mined ever in the history of the world values $6 trillion. Granted, this real estate is not a fully liquid asset, and we don't foresee the total amount to ever be bought or sold in the short term, but we believe that the total asset value is notable from a contextual perspective. When you look at real estate as an asset class, it's about 2.7 times the global GDP as of 2015, and broken down into categories, residential real estate accounts for the lion's share. Residential real estate accounts for about $162 trillion spread across 2.5 billion households. And China accounts for about a quarter of this value, with 20% of the world's population. 21% of this value, however, is allocated to North America, despite only accounting for around 5% of the world's population. And when you look at real estate tech specifically, it's broadly categorized into residential and commercial tech companies, and there's been some significant early wins in the residential market. Companies like Zillow and Private Unicorn out of China, HomeLink, have really seen success. And Zillow has developed somewhat of a listings empire, conducting a good deal of M&A, snapping up competitors like Trulia, StreetEasy, and several others. But by and large, commercial real estate is still an untapped asset for real estate tech. And by commercial real estate, we mean office buildings, hotels, malls, retail stores, multifamily housing, industrial property, and warehouses. The industry has some incumbent players, namely CoStar and LoopNet, but there are some early leaders in the category, including VTS, Reonomy, Honest Buildings, and others. The biggest challenge for real estate tech companies is a data cleanliness issue, as most of the largest leasing terms are purposely opaque and highly guarded. But the reasons to care are namely twofold. The first, that the transaction amounts on commercial transactions are high, and that there are many parties involved, including brokers, mortgage brokers, lenders, developers, etc. In the fourth quarter of 2016, there was a notable commercial real estate tech deal. The VTS Hightower merger created a combined VTS company. This company represents one of the most well-capitalized and significant players in the commercial real estate leasing and management space, with over $100 million raised. So now we'll take a look at some financing trends, and we'll begin looking at the trends from a global perspective. So globally, real estate tech received $2.69 billion of funding across 277 deals in 2016. And through the first quarter of 2017, funding is on track for a record year. At the current run rate, investment activity is on track to reach $2.9 billion invested across 247 deals. This would represent an 11% decrease in deal activity, but a 10% increase in funding. And this decline in deal activity aligns with broader trends in the venture capital space. And compared to 2015, it would represent, at the projected run rate, a fairly robust year. We think it's important to note that there are many companies in the early stages exiting accelerators like Y Combinator, etc. Observing global financing trends on a quarterly basis, we've seen that quarterly deal count has declined of late. After posting 3 straight quarters of over 70 deals, the fourth quarter of 2016 had only 59 deals, and the first quarter of 2017 has increased only slightly above that level. Notable Q1 17 deals included a $375 million corporate minority financing to China-based HomeLink, among others. Looking at the deal share, percentage of deals allocated towards seed, angel, Series A, Series B, Series C, etc. deals. Series A deal share has nearly doubled through the first quarter of 2017. Series A deal share hit 30% in the first quarter, and included financings to companies like Knock, OfferPad, and Nested. Knock is a home sales broker that guarantees a sale within 6 weeks, or it purchases the home at market value. It has raised $32.5 million to date, most recently receiving a Series A financing in January of 2017 from Greycroft Partners, among other investors. And we think that broadly, when you look at the global financing trends, while deal count has declined, the number of Series A deals has increased in real terms, and this indicates a move towards larger deal size, perhaps. Granted, it is early in 2017, and this trend could change over the full course of 2017. Looking at the deal share allocated on a country-by-country basis, you can see that, as might be predicted, the United States takes the majority of deal share, and the United States was home to 58% of deals since 2013. The UK, India, and China were the three largest markets following the United States. We also took a look at the number of unique annual global real estate tech investors. And we've seen that unique active investors has risen year over year since 2013. We're counting here the number of investors that are super angels, VC investors, or corporate venture capital investors. And they've actively increased year over year, making at least one deal on an annual basis. Through the first quarter of 2017, there have been 50 unique investors that have participated in at least one deal. We put together the most active real estate tech investors since 2013, and not surprisingly, Y Combinator and 500 Startups are the most active investors. But Metaprop and VC-focused, real estate tech-focused VC Grey Wolf was the fifth most active, investing in companies like Rentalytics, Common, and Roofstock. Rentalytics develops a property asset management platform where users can compare properties and evaluate changes over time and see trends in their portfolio. The company has raised $13.3 million through a Series A financing to date. We also took a look at the most well-funded real estate tech companies globally. And HomeLink and Opendoor Labs were the two most well-funded globally. Beijing-based HomeLink is an online listing platform which has raised $1.69 billion from investors including Baidu, Huasheng Capital, and Tencent Holdings. Opendoor Labs has raised $319.9 million in total funding to date, and the company buys vetted residential properties up front from home sellers and resells them themselves. In the third most well-funded company globally was Shenzhen-based Fanged.com, raising $311 million in total funding. And notably, VTS, after its merger with Hightower, broke into the top 10. We want to note that our analysis measures the amount of equity finance a company receives, and we've excluded debt and lines of credit in our total financing analysis. So now we'll take a look at the United States financing trends. On an annual basis, U.S. deal activity is forecast to decrease. United States real estate tech companies received $213 million across 32 deals through the first quarter of 2017. And at the current run rate, Deals and dollars are expected to decline compared to full year 2016 totals. Looking at the same numbers on a quarterly basis, U.S. financing mirrors the global trend in that deal count has been down as of late. U.S. Real estate tech companies received $396 million across 30 deals through the last quarter of 2016. And this was one of the lowest deal counts since the fourth quarter of 2014. However, deals increased marginally in the first quarter of 2017. And while we see the directional trend trending down on a deal basis, like we mentioned earlier, it's worth noting that there are a significant amount of companies in the early stages of financing, and they're exiting boot camps and incubators and receiving early stage and Series A financings. Examining the financings by deal share, the U.S. market mirrors the global market as well. In that Series A deal share has increased by 13 percentage points through the first quarter of 2017. And as I mentioned, this mirrors our global financing trends, which makes sense given the amount of deals the U.S. market receives. So now we'll take a look at smart money investment and real estate industry strategic investment trends. So we'll first look at annual smart money financing trends. And we just want to note here that when we say smart money, we're looking at the activity of the top 24 VC firms. And these are selected according to portfolio valuations and investment outcomes. So through the fourth quarter of 2016, smart money investors invested $285 million across 6 deals. And this high amount was largely driven by a $210 million Series D financing to Opendoor Labs. Through Q1 of 2017, smart money investors have invested $110 million across 5 deals. So we've mapped out smart money investments here for you in a business social graph. And we'd like to note that Khosla Ventures has made the most total number of investments. However, New Enterprise Associates has invested in the most unique companies, most recently investing in real estate analytics and listings SaaS company Playster's $50 million Series D financing. However, Opendoor Labs and real estate investment platform Cadre have received the most amount of co-investment among smart money investors. In other words, the most amount of financings in which more than one smart money investor invested. We also created a business social graph for industry strategics. And we like to note that industry leaders have not shied away. So by industry strategics, we mean large real estate property brokers, developers, or investors. So companies like CBRE, all the way to private equity investors like the Blackstone Group. So CBRE has claimed the most investments. Those are highlighted in green, and acquisitions highlighted in orange, acquiring Forum Analytics in 2015 and Floored in January of 2017. Floored is an interesting company. It creates 3D visualization and mapping for real estate. The company has raised $6.26 million to date before its acquisition and included investors like Graycroft Partners, RRE Ventures, Two Sigma Ventures, among others. Now we'll turn to an examination of the 3 largest markets after the United States, being the United Kingdom, India, and China. First, we'll begin with United Kingdom. So on an annual basis, we've seen that largely UK financing has bounced back through the first quarter of 2017. Through Q4 of 2016, the United Kingdom saw a serious lull in both deal and dollar investment, in which real estate tech companies received only $2 million across 2 deals. UK financing activity through Q1 17 has seen $42 million invested across 11 deals. So now turning to the India market, On a quarterly basis, the trend through Q4 of 2016 saw few deals in India, and this trend has remained constant. Deal activity in India continues to be low through the first quarter of 2017, in which $64 million was invested across 3 deals. This was largely driven, however, by a $55 million financing to PropTiger, which included investors Excel Partners India and SoftBank Group, among others. Real estate tech in China has seen deals increase, albeit marginally, through the first quarter of 2017. So deals to Chinese real estate tech companies increased to 4 in the first quarter of 2017 over 2 the quarter before. And funding also increased from $34 million through the fourth quarter of 2016 to $411 million through the first quarter of 2017. However, this total funding amount was largely driven by a $375 million corporate minority financing to HomeLink. It's worth noting here that HomeLink received an $872 million Series B in the second quarter of 2016. We wanted to compare here the UK versus US real estate tech deal activity on a quarterly basis. And just to show that the UK market is especially active through the first quarter of 2017. And we think this recent spike in activity is particularly interesting considering recent political events like Brexit. We've compiled the most active investors across these 3 markets, and Seedcamp, UK-based Seedcamp, is the most active investor. Operating out of the UK market, they've made investments recently in Trussle, Reposit, and eMove. Trussle is a UK-based mortgage broker, and eMove is an online real estate listings platform. Reposit is an interesting company in that it manages security deposits that are needed to move into property in the United Kingdom. So tenants pay a one-week fee through their letting agent, and Reposit provides 6 weeks worth of deposit coverage to landlords. Tenants are liable for the outstanding balance of the damages at the end of lease term, but it's an interesting concept. Notably, also an active investor is Zoopla, which was tied for the second most active. And this is of particular note, we believe, because Zoopla is a corporate and not a VC firm. The most well-funded UK, India, and China real estate tech companies, of course, just as the global trend showed, HomeLink was the most well-funded in these 3 markets. And it's worth noting that 3 of the top 5 most well-funded companies operate out of the China market. PropTiger, which was tied for which was the 3rd most well-funded company, is an India-based company which allows real estate developers to sell their inventory directly to home buyers. The company has raised $89.8 million to date. So we just had a quick note on the China market, and that is capital outflow. So through the full year 2016, Chinese investors invested $33 billion in overseas real estate, and this was up 53% from full year 2015. The United States received $14.3 billion of that total. And a recent real estate tech partnership that we noticed, which was largely driven by this trend, has been a partnership between JUY and Berkshire Hathaway Home Services. Berkshire Hathaway Home Services being a subsidiary of the Berkshire Hathaway Holdings Company, and JUY being a private international real estate online portal which connects Chinese property buyers with sellers around the world. And we believe this partnership will serve the Chinese market by allowing Chinese customers to invest in United States homes. So now we'll take a look at some early stage deals and financing trends on an annual and quarterly basis. So starting with annual trends, we've seen that early stage activity has decreased by and large. Investors invested $173 million across 39 deals through the first quarter of 2017. And at the current run rate, full year deals are expected to decline by 15%, while dollars are expected to increase by 20%. Like we saw in the global trends, however, early stage financings are shifting from seed to Series A rounds, and this might indicate a larger round size, so less smaller seed rounds and perhaps larger Series A rounds. However, it is early in the year in 2017, so this trend may change. On a quarterly basis, we've seen that deals have increased slightly over the fourth quarter of 2016 through Q1 2017. But are down 15% compared to the first quarter of 2016, so 1 year prior. We wanted to highlight for you some startups that have raised early stage funding since 2016, and certain of these startups fall into residential and commercial, so these two categories are not entirely exclusive, but we've highlighted residential real estate tech companies, including mortgage lending companies, as well as commercial real estate tech companies that have received seed or Series A funding since 2016. From a residential perspective, the company OfferPad is notable to us. Like Opendoor, OfferPad is a direct home buyer and provides home sellers with market prices for their home. The Arizona-based company recently raised a Series A and debt round from LL Funds, which was a combined value of $260 million. A mortgage lending company that we think is interesting is Eve, which is actually yet to launch nationwide, but is a New York-based mortgage tech company which is trying to make mortgages more transparent, simple, and competitive for the actual mortgage buyer. The company has raised $7.3 million in funding to date, most recently raising most of that in a Series A in the first quarter of 2017. So lastly, we'll turn to some trends to watch. These are some trends that we're keeping an eye on, we think are important and are affecting the real estate tech industry structurally. We'll also highlight some early stage startups that are participating in these market opportunities. So our trends fall into three main categories, the first being the rental economy, the second being the mortgage market, and the third being the retail real estate market. So we'll start with the rental economy. A trend here is that home ownership has been declining. So per the U.S. Census Bureau, home ownership is at near record lows through Q1 2017. And this is largely driven by low inventory and low single family construction, which has not rebounded to its pre-recession levels. We've also seen an increase in landlord-owned homes. So one of the reasons why inventory has been low for home buyers is that the share of U.S. homes that are landlord-owned has risen. So according to Bloomberg, through full year 2016, the share of U.S. home sales for which the owner does not live in the home increased to over 35%. And we're seeing this trend being especially active in lower value markets. So places like Dallas over a metro area like Seattle, where the margin for a landlord is higher. There are consumer-facing startups which are operating in this trend, one of which is Roofstock and the other which is Mind. Roofstock is an online marketplace and community created exclusively for investing in leased single-family rental homes that generate cash flow from day one. Consumers are given research, analytics, and insights to evaluate and purchase independently certified properties at prices that reflect both market and property conditions. But what this trend has led to is that most metro areas are now majority renter. So with low market inventory, more potential homeowners are actually staying within the rental market. And this has been difficult for the metro area renter, as city rent rates are at near record levels. So despite recent flattening of rent rates through the second half of 2016, metro area rent rates are significantly higher than their historical averages in many US cities. But there are some startups that are operating in this market opportunity, so in the rental economy. An early stage startup we feel is notable that is serving the supply side is a Y Combinator alum, Resi, which is serving the landlord market. So Resi acts as a tenant and rents properties from landlords on an annual basis, and then re-rents those same properties to consumers. An early stage startup which is serving the demand side in the rental economy is RentBerry, which has controversially placed itself between the landlord and prospective tenants and allows tenants to bid up the price of the monthly rent on high demand properties. RentBerry has received seed financing from Google Ventures, among other investors. Another trend we're keeping an eye on is the mortgage market. Historical mortgage spend has been down while rent spent has been up. And mortgage affordability to many economists is a major concern moving forward as more income is allocated towards rent. So first home buyers are saving less while they're spending more on rent. Examining the amount of income spent on mortgages in metro areas, some metro areas are at or above historical income spent on their mortgages, not accounting for expected increases. So cities like San Francisco, 42% of income is spent on mortgages, while cities like Chicago are actually less than the historical average. But mortgage affordability has by and large affected the lowest or bottom third of potential homeowners. So mortgages for the bottom third of homeowners are the least affordable. And this is largely driven by two main factors. The first being that homes in that bottom third have increased or appreciated in value the fastest compared to homes in the middle or top third, while potential home buyers in that bottom third have also seen the slowest growth in their income. Some early stage startups that are serving the mortgage market are Approved, which is a loan platform for existing lenders. Approved provides consumer-facing tools that streamlines the 1003 form and also provides back-office tools that interface directly with client banks to receive documents and cut down on average loan times. Approved has recently seen pre-seed financing from Social Capital, among others, in the first quarter of 2017. A more established mortgage startup is Blend Labs. Loan platform Blend Labs partners with lenders to make the loan process easy and transparent, and has helped to make the loan process faster. Blend Labs has raised $42.5 million to date from 8VC Founders Fund, Lightspeed Venture Partners, among others. Lastly, the last trend we are keeping an eye on is the retail market. And so within retail, store closures are on pace in 2017 to eclipse closures in the recession of 2008. And while most real estate property managers point to a low quality retail space as a driver of closures, pointing to a statistic that of 7.5 billion square feet of retail space, about 1.2 billion of that is considered high quality. It's worth noting that even prime retail real estate in areas like New York City has seen increased vacancy. So according to Bloomberg, Fifth Avenue stores are increasingly left vacant. Fortune writer Aaron Griffith recently wrote that there is a large opportunity for venture capital-backed companies in the real estate tech space to reimagine what will happen to these abandoned storefronts, especially in metro areas that are short on housing supply. One such startup is With Me, which is a retail on-demand startup. It has created an on-demand platform for short-term retail spaces in high-traffic and desirable locations, offering space in New York, LA, Chicago, Washington, D.C., and Portland. With Me raised a $32.8 million Series A in the third quarter of 2016. Notably, one of With Me's investors is Macerich, a real estate investment trust headquartered in Santa Monica, which is the third largest operator of shopping centers in the United States. Another early stage startup to watch is Bulletin, which is a Y Combinator alum. Bulletin allows brands to sell their products in retail locations by renting sections of their stores on a month-to-month basis. The company is currently targeted in New York, but seeks to expand to the LA West Coast market. Lastly, Appear Here is another company that is operating within this retail trend. Appear Here is an online platform that connects landlords to short-term retail renters. Appear Here has raised seed and Series A rounds and is headquartered in the United Kingdom. So that's all we have for you today. Thanks very much for tuning in. And as we mentioned earlier, the full presentation will be sent to you following.
Okay, everyone, thanks again for joining. Alex is going to take a few minutes to just answer questions, so please submit them using the questions tab within GoToWebinar. Thank you.
Okay, so now we'll take some questions posed by a few of you tuning in. One question is just sort of a follow-up on the UK market and the recent real estate tech activity, deal activity there. Obviously, there has been an increase in deals through the first quarter of 2017, and we think it might also be interesting to note there, Bloomberg recently reported that the use of short-term rentals via vacation rental websites like Airbnb and others has increased through full year 2016. And we think this is of particular note, especially with regard to the London market. So Bloomberg reported that there's been several luxury homeowners in London who are not seeing a lot of demand in terms of long-term rental leases. And according to Jones Lang LaSalle, the number of London properties listed on Airbnb has almost doubled through 2016 to 50,000. This is combined with the fact that a large number of high-end London properties are slated to come on the market through the next decade, and is combined with the fact that a good deal of high-end London properties are owned by overseas buyers. They make up about 41% of home purchases in some of London's most expensive neighborhoods. And they've recently been experiencing a decrease in the value of the British pound, which has fallen about 16% against the dollar since Brexit. So this means that pounds received in long-term rent leases go, less towards paying their servicing their mortgages, and might incentivize the use of vacation rental websites like Airbnb to fill this gap in the short-term market. So that was something that was notable in the UK market, and we thought it'd be worth bringing up here. The next question which we received had to do with the listing and broker space. So someone commented they've noticed that the listing and broker space is seemingly get quite crowded, including companies like Redfin and Compass and others, and they were wondering whether or not there might be consolidation on the horizon. So, we've observed that there's been early success in listings companies, like we mentioned at the beginning of the presentation, listing companies like Zillow, making acquisitions of other listing services like Trulia and StreetEasy. And by and large, these listing platforms operate as advertising businesses. So Zillow gets real estate companies to list their listings on their platforms for a fee. And so it's very much a pay to advertise model. They effectively levy a tax on real estate transactions. Redfin, conversely, has confronted the real estate agent market more directly and competed largely on price. This includes other companies like Compass, I mentioned as well. And Redfin, directly employs agents. They pay these agents a salary. And they compete with other more traditional real estate brokerages largely on price, taking about half the typical selling agent's fee. So what I think most people have observed is that this has driven the rest of the traditional agent market to compete against listing services, to compete directly against Redfin, Compass, and others. To Redfin's detriment. In this respect, you could very well, in our opinion, see consolidation among companies like Redfin, Compass, and TripleMint, among others, that might seek an economic edge via consolidation. The last question we'll address here is how challenged companies like Opendoor and others, how challenged economically are they by putting houses on their balance sheet? So Opendoor is an interesting example to discuss in the context of this question. Opendoor's business model largely operates on a bid-ask spread. So they make below-market bids to home sellers and then profit on the market rate difference. This does cause some risk to be left on their balance sheet, but in theory, only for a short period of time. So they advertise that they have a 3-month model from purchase to sale. There is, it's important to note that there is liquidity risk should there be an economic downturn. This turnaround time from purchase to sale of about 3 months would likely extend in an economic downturn as demand would decrease. It's also worth noting that Opendoor was started during quite stable market conditions under friendly monetary policy and with, as we discussed earlier, intense international demand for U.S. real estate coming from countries like China and others. In terms of their balance sheet specifically, though, as the question asked, Opendoor actually buys with debt. And so if their turnaround time's extended, this would increase the cost of servicing that debt. Well, thank you very much for your questions. That's all we're going to address at this time, and thank you for tuning in.